Hey guys, it's Steve Lamott, the founder at Elevate Realty Group, and today I'm really excited. We're talking about federal and state governments taking money from you. I know nobody loves that. And remember, like or subscribe to our YouTube channel if you enjoy these educational videos, or follow us at Homes by Elevate on Insta or Facebook. So let's break down capital gains taxes. No one loves to pay taxes. However, it's a very powerful tool, capital gains and appreciation, in your wealth building journey as you invest in real estate and or you own your own home and you build up your nest egg with equity. So capital gains taxes in a nutshell are taxes that are taxed on appreciation on an asset. It can be a stock, bond, jewelry, artwork, but we're talking about real estate and real estate appreciation. So it's important to understand with capital gains tax rates that they're actually lower than income tax rates. So if you make $200,000 in appreciation and you make $200,000 by working, you're actually going to pay less tax in capital gains taxes because that money has already been taxed in theory. You took whatever you took, $200,000, put it down on a house that was already taxed. Any appreciation you see it's almost double taxation, if that makes sense. And that's why capital gains tax rates tend to be lower than income tax rates. So, for example, we are seeing more and more people over the last 2 years run into paying capital gains tax rates. Before COVID, it was very rare to have someone see appreciation enough to have to pay their capital gains taxes when they go to sell. The two rules around capital gains are, if you're married, you can defer up to $500,000 in gains. Very powerful tool when you're building your nest egg and your wealth. If you're single, you can defer up to $250,000 in gains. What that means is, if you bought a home for $500,000 and then you sell your home today for $1.1 million, you can defer $500,000 in profit without paying any taxes. That is incredible. And then the additional $100,000 over the million, you're going to pay your capital gains tax rates. Now, I'll add a disclaimer. There are long-term and short-term capital gains tax rates. We're going to talk about long-term, and that pertains to real estate a lot of the time. So let's take that example. You sold your home for $1.1 million. You bought it for $500,000. You're married, so you're only taxed on that $100,000 over $1 million. Now, capital gains tax rates are based on your current income bracket, which is unfortunate. So those can range between 15% at the federal level, all the way up to 23%, I think, this year, if you're in the highest tax brackets. In the good old state of California, there's an additional capital gains tax rate at the state level. So some people in certain income brackets could be paying upwards of 30% on that $100,000 profit, which is a lot of money. And it's something that you want to factor into making your decision and making your plans when you go to budget after you sell. This is not an issue that comes up often. However, after COVID, capital gains has played a serious issue, and I've had more and more people having to pay big chunks of money to the state of California and the feds after we've seen so much appreciation. I will add another disclaimer. Capital gains is a magical thing, right? We should be investing in assets as they grow in value. It's your money working for yourself, right? You're not having to put any time. You're not on the job. You're not putting in hours. The wealthy, when you hear the people on the news say the wealthy pay no tax, what they mean is they're taking advantage of the current system, and rather than earn just income, they're investing their money and they're seeing long-term capital gains and paying a lower tax rate than if they were earning that money by just working. In most income tax brackets, certain people are paying upwards of 40% tax on every dollar they earn when they're working. However, if they invest that money and they see capital gains, they may be paying as little as 20%, in some cases 15, 18%. Which would you rather pay? Would you rather give 40 cents of every dollar or 18 cents of every dollar? So if you enjoyed this video, follow us at homesbyelevate.com or like or subscribe to our YouTube channel. Again, capital gains taxes. There are long-term and short-term. When it comes to real estate though, however, it's long-term capital gains tax rates. You can defer up to $500,000 if you've lived in the home for more than 2 years, which is a very powerful tool in your wealth building journey. If you're single, you can defer up to $250,000. Thanks so much for watching.